Right.
Okay, we are live, folks.
Damn. I've just clicked it. Right. Okay. We're live. Everybody's favorite property show. Welcome to this week's edition. And I know I was Skiving last week, but welcome. Got a special co-host, got Surinder, and we got the man. Yeah, this is being recorded. Right. No more swearing, folks. Right. We got the man we thought we needed. But I think we're going to need a queue of experts with the way things are going. I'm going to try and resist. No, look, get your 50p's ready because the power cuts are coming. You need them for the meter. And I'm just going to throw it over to my sensible co-host. Charanjit, do you want to say a word or two before we go to our special guest?
Yeah, I mean, it's my pleasure to introduce Arif to the show again. I'll just say a little bit about him. Arif is a proud co-founder and partner of MapPlus, an award-winning firm of chartered accountants. After acquiring a double bachelor's degree in applied accounting, he went on to become a member of 5 other professional bodies, which included the Association of Accounting Technicians, the Association of Chartered Certified Accountants, the Institute of Chartered Accountants, and also the Chartered Institute of Public Finance, as well as STEP, which is a global professional body of lawyers, accountants, and trustees, which help families plan for their future. He further developed his property tax specialization by assisting both the UK and foreign nationals to build and sustain their property portfolio in the most tax efficient manner. He also sits on AT&T, which is the Association of Tax Technicians, a technical VAT subcommittee to share his knowledge. With his appearances on television and as a seasoned speaker at various conferences and business forums, he has a wonderful mix of charm, authority, and passion. And today he's going to talk to us about the impact of the mini budget on landlords. Over to you, Arif.
Wow, I didn't know I had so many qualities. But thank you all. Always a pleasure to speak at the Property Professionals networking event on the Zoom. And could I start with sharing my screen, if I may? Just bear with me. Is it all visible to you guys? Is it all okay? Brilliant. Thumbs up is there from all of you. So today's topic would be the mini budget impact on the property entrepreneurs. And I would use the word entrepreneurs as opposed to investors because it includes everybody linked to the property industry, as in the landlords, investors, developers, and all of the professionals, part of the property professionals. So yes, the mini budget impact, much of that we have already heard and seen in the last 2 weeks over the media, and the impact purely and surely, if not less, as opposed to the budget impacted during COVID-19. So let's go into the fact of, I mean, I would not go in detail as to what all the nuts and bolts within the mini budget, but actually rather just affecting us as a property entrepreneurs within the industry, and how we could perhaps then foreseeably in future protect ourselves from the taxes and other areas to mitigate and have more efficient property business. Now, much of it, before I proceed, I'd like to introduce myself, which much of that has already been introduced by the introducer, Charanjit, very kindly. So thank you very much. Yes, I'm a member of 5 professional bodies and now part of a partner of an award-winning firm of chartered accountants. We've got 2 offices, Wembley and King's Cross. But more importantly, I'm also a property investor, I'm a London landlord, and I've got a few joint ventures as it is going. So at the same time as looking at it from the professional's perspective of having the property tax implication on the clientele's affairs, it also affects my bottom line when I put myself into the shoes of the client as a property entrepreneur. So I can see the pain from both the sides and to perhaps oversee and turn it back to make sure that we have our tax affairs aligned in a most efficient manner. So let's go on to just the income tax side, onto the income tax, and I would use the word income tax mockery into the money budget that was been introduced. So briefly, this is what has been introduced. So basically, is the level of income tax that we all pay once we reach more than the personal allowance, which is 12,500 circa. So each and every UK, whether citizen or non-citizen, and I shouldn't be using the word citizen, but each and every UK resident or taxpayer rather, earning more than 12,500 should be paying 20%. Now they'll be paying just a very lesser compared to what they used to pay, just 19%. But this is the major one, which is the additional rate. It was introduced earlier to be 45%, reduce it down to 0, and only to go back again 45% within a week's time. So I think it's in the history itself in the budget that what was been announced has been then re-announced to make it go back to what it was before. Something similar in terms of the story with the dividend rates as well. We had 7.5% earlier. It had gone up rather to 8.75 in the previous budget, and now only this budget has come down to 7.5. It's just a joke at times when you look at these figures and then you've been thinking, make your mind and decide and move on from there. But it doesn't stop there either. It's 32.5% for the higher rate earners, so those whose income is more than £50,000, and if you withdraw any dividend from your company or any other company that you were to have your investments or shares in effect, if it's 32.5%, that means every £100 that you have earned as a dividend over and above your 50K income, whatever it comprises of, whether it's your rental income or employment income, you are effectively paying almost 32.5%, which is almost 1/3 of every £100 that you have earned. So almost 1/3 of every pound that you would get as a dividend, you're going to pay tax on it. That had again was asked to go up by 33.75, only to go back to again 32.5%. So when you look at it overall, it actually makes no sense. As to the income tax side of it, more or less it has remained the same, but only to create more hoo-ha within the pound sterling that has gone down as a result of the additional rate, because it looks more biased towards those who earn more than £100,000 worth of income. But having said that, that's what in essence for the income tax, more or less that remains the same, which affects the majority of us, if not all of us. What impact it would have? Again, there are legislation attached to it which says stamp duty land tax reduction. And I would just go very briefly because I understand there was an STLT advisor who had come and spoke last week itself. In essence, the legislation affecting the stamp duty land tax is only benefiting us by 2,500. So us as if you were to already have a property and if you were to buy for second or more property, you're better off by £2,500. Only you'll be more better off if you are a first-time buyer. Just kind of a booster. But other than that, it's not a major change. It's more or less almost the same, apart from £2,500 worth of change. Now, as a result, we all know the sterling has gone down. The interest rates have inevitably gone up, and they've got dramatically up, and it is predicted to be going up more further with the Bank of England basis going up. The impact of that for us as the property entrepreneurs, because majority of us, if not all again, would have some associated finance cost, mortgages and lending on the properties. And yes, much of the predictions of what the property gurus and the specialists would say, how the property prices would be, my prediction would be, yes, in the short run, it would be somewhere going down. If not, I would say stagnant. It would definitely not go up, despite the fact that we have lesser supply, but at the same time, people should be able to afford to buy as well. And given what the conditions are in terms of utilities and the interest rates, people, even those who would have money, would try to hold on to it just to get things much more calmer in the market before they start spending on it. So that's in essence in terms of property prices. How it would affect us, the interest rates since have gone up, that means our mortgage cost obviously have gone up. As a result, our profit has gone down inevitably. But why I should be worried about them? Because if my profit has gone down, surely my net income that I'm taking home has gone down. And even worse, which majority of us would know, those who are landlords, there's something called Section 24, which restrict us from deducting our mortgage cost from our rental income. So with the mortgage cost going up further, that means more of the cost that we are paying from our own pocket that we cannot declare and we cannot deduct against our rental income, i.e. more tax on one hand we are paying on our rental income profits. At the same time, more money is going out from our mortgage cost, which we can't even deduct. So my net earnings and my net savings in my pocket after paying the mortgage cost and paying the income tax or the corporation tax, depending on the entity that I have from property income rental activities, are getting lesser and lesser. It's really squeezing us with the rising mortgage cost. What do we do to tackle Section 24? I have addressed this before as well, and there is no better time to address it now than before. That if you are a landlord and if you have got multiple properties, you should sincerely consider doing the property portfolio incorporation, purely because of the illustration that I'm about to go for. So 5 or more properties is what I would say. Don't put it as a benchmark, but this is a start. You need to consider your property. If you have a portfolio of properties, whether it's commercial or residential, doesn't matter. More than the 5 properties, I should rather say whether you are confident and comfortable enough to say that you're spending 20 hours a week or more on your property portfolio management. It doesn't have to be yourself. Even if you are outsourcing that particular work to an estate agent, an estate agent is supposed to be spending 20 hours a week or more on managing a property portfolio, then you are fine, and you should be able to incorporate your property portfolio business, i.e. you should be able to transfer those properties from individual name into the company name. And why would you do so? I'll just go through with some of the advantages. So number one is the capital gains tax savings, because the properties that gets transferred from the individual name into the company name gets transferred at the current market value to be the new base value. What does it mean? It simply means that, say, for example, I bought these properties, I bought 10 properties worth £1 million back in 2000. Now, these properties are worth 2.5 million. When I transfer them into the company, the revised market value to be the base value means now they are valued at 2.5 to be the new cost price for the purpose of company. So tomorrow, maybe a year down the line, if I decide to sell them all and go to Bahama and have my retirement, and the property prices were to be, if my selling price were to be 2.6, then 2.6 minus 2.5, it's not 2.6 minus 1 million. So I get a huge capital gains tax savings of any increment my property portfolio has seen ever since the date of purchase till now, which is a massive capital gains tax savings, which is still there as of now. You never know whether it will be there tomorrow or not. So it's ideal for those who have the land, those who are the landlords and having more properties, should do the incorporation purely because of the capital gains tax savings itself. Forget about any income tax benefits as well. So that's onto the capital gains tax. Then comes the income tax. Yes, in Section 24 is there, which means the mortgage cost can be deducted and should be deducted against your rental income, as opposed to you being an individual. As we all know, we can no longer deduct that. However, if your property portfolio and the rental income were to be up to 50K, then Section 24 would not affect. But again, we are not discussing about those 1 or 2 buy-to-let property landlords. We are talking about those landlords who have got significant amount of rental income coming out from the property portfolio, on which they more or less rely on their day-to-day livelihood. So income tax saving will be a great lifesaver, in other words, because all of the mortgage costs with the increase in the interest rate, even those increase, yes, it has, at least the least that can happen is that it can get deducted against your rental income, so that your net profit, which is lower, now you'll pay a lower income tax rather than paying a higher income tax. While at the same time, you also pay the mortgage cost. So that's onto the income tax savings. Then comes the director's loan account, a bit more complex than just a one word saying tax-free withdrawals from the company post incorporation. But in essence, what is happening is the directors or is the individuals who are transferring the properties from individual name into the company name. That means they have put in their equity in the company. Now they can withdraw those equity out from the company tax-free. That means the dividend that I have discussed earlier, which had to be almost 1/3 if your income were to be more than 50K, would be saved. So more funds you can withdraw from the company, not classified as a dividend. You are saving almost 33% of dividend tax savings as well to the director's loan account. Then comes the freezer share structure or smart company. Many of us must have heard of it, which purely mean that if you transfer the properties into the company name and you freeze the structure within the shares of your company in a way that there are two classes, Class A and Class B. The value that got transferred, which I go back to my previous example of 2.5 million circa, your 2.5 million gets frozen for the purpose of inheritance tax. So say 15 years down the line, the person were to die and the value now is 4 million, only the increment in the value, which is from 2.5 to 4 million, which is 1.5 million, is exposed to inheritance tax, safeguarded from inheritance tax. So when we say freeze a share, i.e. the 2.5 is only exposed to inheritance tax, any increment goes to your beneficiary, which could be your children, it could be anyone that you put in within the trust deed, would get any increment within your property portfolio business free of inheritance tax, which is again a huge, massive inheritance tax savings if you consider it and do it appropriately. And that's why it's called smart company, because it smartly pass over any growth in terms of capital growth occurring to your property portfolio to your selected beneficiaries free of IHT. And last but not the least, which I have almost kind of touched onto the previous tax loan account as well, but this is more onto the flexibility on the dividend distribution, which means that, apology, let me go back. If you were to be an individual and if you were to have a rental income, all of it would be declared as a deemed income of yours, which is actually your actual earning. And you would declare that and you would pay income tax directly on it. If you were to have the company, then surely company would pay the 19% corporation tax or whatever the level of rate that you are eligible for, but then it could potentially end there, provided you do not withdraw dividend from the company. So you are not subject to more income tax personally, as opposed to just a flat rate of 19% corporation tax, which could be pretty good, given the fact that you could be penalized up to 40 to even 45% onto the income tax side of it. So you have the flexibility. So those who are better off, those who are well off with the current income level that they have, and they may think in the next 2-3 years, I may not need to withdraw more dividend. Well, then you would not have to pay more income tax on any withdrawals that you take on from the company, because you have the option A to consider those withdrawal as a director's loan account, and you don't consider them as a dividend. And when it comes to dividend, you can control your dividend up to only to the extent that you need to withdraw more from the company, if that makes sense. So all in all, on the incorporation, there couldn't be any better time. But again, this is not one fit for all. It applies primarily for the landlord property portfolios, those who have at least 5 or more, and whose income is more than 50K gross from the rental income. With the illustration, this is the individual with the income tax level for the last 3 years. And then let's go with the company side of it. Once the individual has converted his property portfolio into a company name. Now, 2016-17, the rates, £2,700 worth of total tax payable compared to 5,400. And then go 2018-19. In this illustration, if you look at it properly, what we have considered is all of the amount that the company has actually received in terms of rental income. The directors have then gone to consider withdrawn the entire amount as a dividend as well. So it is the maximum tax that you potentially could pay using a company. But when you compare that with the 2018-19, you're saving 1,431 purely just on the rental income of 30K. And of course, more the rental income, more your income tax savings would be. But it actually starts hitting more because, as we all know, Section 24 is a phased deduction. So in 2018-19, you could still deduct 50%, but come 2021, you cannot deduct even a single penny up until the fact that your income goes above 50K, then you cannot no longer deduct. So the tax increment that has come up as £3,000 compared to what it was in 2016-17. But when you compare 8,400 with, apology, £5,469, which is the total maximum that you could have paid, including the dividend tax, is 2,931, which is circa 3K worth of tax savings. What usually tax advisors tend to compare is 2021 figure of tax liability of 8,400 with the corporation tax of 2,565. Now, while that is a good comparison, because then that would give you more savings, purely because 8,400 minus 2.5 is a huge figure of £5,000 tax savings. I don't really think that is a more similarity in terms of the actual take home, because under individual, you're actually taking home the entire rental income compared to the corporate. If you were to take home more, you would be further subject to dividend tax on it. So this is most unbiased view of comparing it on the company side, which includes not only just the corporation tax, but also the income tax, which is the dividend level, as opposed to the individual level here, we're just paying the income tax at the basic rate level, and still the savings are there. So no two ways about the fact that there is no better time. If you haven't done so, please do so, but make sure, obviously, don't do DIY. As you transfer the properties individually under company name, it triggers minimum of 2 taxes, if not more. The number 1 is capital gains tax, and number 2 is stamp duty, land tax. And HMRC has stopped giving clearances on transfer of properties into the company name, purely because of the number of applications that had gone in early 2017-18. So you have to consider that if you are going through this particular tax planning route, you're going on your own. And HMRC could come back to you stating, oh, give us more calculations and attachment attached to it to see whether it justifies. So making sure whoever tax advisor you used have sufficient professional indemnity insurance and they're covered by the professional bodies. That's onto the incorporation for those who have 5 or more properties. Let's talk about those who have 1, 2, or perhaps 3 properties. There are few, they want to be buy-to-let portfolio landlords, but they have few as of now. And again, they are hit by the interest cost. How and what can I do? The tool that we use is the UK trust that we form, by which we transfer the equity of the particular property into the trust. It doesn't require change of title deed because all we are doing is transfer of equitable ownership compared to the legal ownership. But before I go there, let me define what the trust is, because many a times people are astonished and perhaps more surprised when the word trust come in. They think, oh, this must be complex or this must be expensive. It doesn't have to be, as long as you know what is going in and out of it. Trust is just simply nothing but an alternate form of gifting. It actually segregates the relationship between the equitable and the legal ownership. It purely means is that if I were to own this particular pencil, then I've got a legal ownership. But at the same time, if I'm using it, then I've got equitable, which is the beneficial ownership as well. With the trust, I segregate the both of them. So the trustee would have the legal ownership, which means they would own the pen, but they are transferring the beneficial ownership to the beneficiaries of the trust. That means they cannot use the pencil. The pencil use can only be passed over to the beneficiaries up to the discretion of trustees. So depending again on the type of trust that you create. So let us look at the difference between the outright gift and the trust. So if the outright gift were to be there, it's my pencil, I'm the donor, I decide to give it to my son becomes the donee, and it literally just transfers from one person to another. And as soon as I give the pen away, or as soon as I sign the deed of documentations, it becomes completely of donee. Now, legal and equitable ownership both goes to the donee. So now if the person decides, if I have transferred the property to my son, and if he decides to sell and go for holiday or buy expensive car, then that's all gone away. That's not what I intended to. However, since I have lost the right to legal ownership, that what can occur. As opposed to trust, there are 3 parties here. And that's why the word perhaps trust came into place, because as much as I love my son, I perhaps do not have sufficient trust in him. And that's the reason I used a tool called trust, whereby I transfer the same property to trustee, say a friend of mine to be a trustee, I myself could be a trustee, whereby we own the legal ownership. So the title deed cannot be passed over. It remains with the trustee. It's just the beneficial ownership. So perhaps if it's property which has been transferred into trust, and if the property were to be a buy-to-let property, the beneficiary could potentially receive the rental income from it, subject to our consent. So that's why it's called a much more smarter way of giving it away, because even in the first one, outright gifting, once you have given, it's given. But in case of trust, say I have put it into trust, God forbid, World War III has occurred, and I've got nothing left apart from what I had actually given in trust. I can decide to dissolve the trust and take my property back. So it's got more flexibility in terms of not only just dissolving it or revoking it back, but also in terms of maneuvering it and passing over the benefits to any person. So if I've decided to put beneficiary as my son, and if I want to take it off, I can take it off and put any Tom, Dick, and Harry as a beneficiary. So there's much more maneuver there to play around with. And yes, there are some protectors as well, which can be party to the trust, but it's not applicable here. It's mostly for the offshore trust. But why we are talking about the trust and how can trust help us mitigate the income tax? Let us look at the two examples that we usually use for, and we form the UK trust for these property entrepreneurs. Those were, again, 1, 2, or 3 properties. That's why it's more beneficial. Again, we can also put some of the property portfolio incorporation chunk into trust, depending on the status of the person. So what usually happens is, depending on the type of trust you create, you pay tax. And as much as we must have heard about various types and the names of the trust, they are just, perhaps I would say, the characteristics of a particular trust, such as a doctor, lawyer, a politician. But in essence, without exceptions, you would normally have just a male or female in terms of human being. Similar goes to the trust side of it. You have only 2 types. One is interest in possession, the other one is discretionary trust. And again, depending on the type of trust you create, you pay tax accordingly. But whichever trust you go for, you've paid those taxes. So in terms of interest in possession trust, you've paid 20%, which is 4,000, as opposed to discretionary trust, you paid 45%, which comes to 9,000 pounds. Now comes the magic part, in which that if you have given these particular dividend after paying your trust taxation, what is now left over is 11,000. If you have given it to the beneficiaries whose income is below the basic rate band, i.e. they've got no other income, or this purely the only income that they have, when they file their self-assessment tax return stating, look, I've got dividend from the trust, HMRC refunds them back the proportionate amount of tax suffered by the trust to them into their bank account. Sounds very surprising and sounds too good to be true, but it is. Because trust is a very niche area and very few people specialize into it. And not many people would do the trust accounts as well. So yes, that's true. You get the full tax refund back, but not you as in the trustee, but as a beneficiary. So in essence, if you were to look at it, 11,000 plus 11,000 becomes 22, which goes back to the actual rental income that we had before. So yes, the magic in here would be the fact that not only the fact that mortgage costs would not affect you, you are actually paying 0 tax if you are smart enough to appropriately plan your affairs in a way that you give it to beneficiaries, those who have got no UK income. The beneficiaries also, to the extent, doesn't even have to be the UK beneficiary, UK resident. You can decide to give the non-UK residents beneficiaries as well. There is no limitations here. And as long as you file the tax returns with the UTR number, they would get the tax refunds from HMRC. So this, in essence, just to elaborate onto some of the areas that within the property sector, we could do the tax planning of, which I have explored in terms of the property incorporation, portfolio, and also where you own 1 or 2 properties, do the trust tax planning. In addition to it, there are many other ways, such as using the capital allowances. If you were to buy a commercial property, not many are aware that up to 20% can be claimed back from HMRC on the purchase price that you have paid for the property. So if you've paid, say, for example, £100,000 to buy a commercial property, would you be not happy more if you were to get perhaps £20,000 back from HMRC as a rebate? And so on and so forth, that are there linked to the property that we could get benefited from, but it just requires a bit more savvy use of tax plannings and legislation associated with it. I hope I have made the most of your time, and feel free to ask me any questions. Feel free to also get the QR code that I have attached here to get any questions that you have. Thank you all, and thank you for listening.
Very interesting, Arif. Where's the slot for the 50p?
50p slot is just there when you use the QR code.
Okay, so you've got to scan the QR code to see the 50p slot. Now, Charanjit, have you got a question? Okay.
Charanjit, you're muted.
Yeah, I think that's really enlightening, Arif, if the difference that a trust can make and the tax savings. Yeah, from obviously from an inheritance tax point of view, that was really useful. Thanks, Arif. Yeah.
So it's not purely for the inheritance tax, it's
Mhm.
majority for the income tax as well. So
Okay.
it's ongoing income tax that you could save potentially.
Yeah, but I think it's really valuable to know tax planning. So that's really interesting, and the incorporation as well. If you've got more than 5 properties, I mean, my
Yeah.
question was, if you've got 5 properties all together, and say you've already got a couple of them in a limited company, and you've only got, say, 3, would it still be worth incorporating? Or
So are you saying that you have some in the company name and some in the individual name? Then it really requires the overall review of your individual income tax return, whether you've been hit by the basic rate band. If you are, then it's still worth it. Or even if you are not, but you are planning to buy more,
yes,
then it would sometime in the future, then it surely should. But again, it requires looking at your income tax affairs and see overall what impact really it would make, given the numbers. If you're already hitting 100K in your gross rental income, then definitely yes. There's no question about it.
Thank you.
Arif, you compared, so, and I'm not going to accuse you of using old slides, which you probably did because you didn't want to update the dates. But just an interesting thing, those illustrations are from 17 to 21. I know you haven't got a TARDIS. I'm not going to lend you mine, but perhaps it's an idea for people to think about 22 and going forward, because when you looked at the 100% deduction, 50%, and as it tapered down, going forward, those options aren't available. So looking at
absolutely
going
not.
forward,
Yeah. So 2021 was the dead end. So
yeah, 2021's gone, mate. I know you missed it.
Yeah.
We were busy in the lockdown and we had other stuff going on. But from 20 to 21 and 22, it's all gone, right? So looking forward,
even those, so anything after 2021, what you're trying to say would remain the same. So there's 22, 23, or going forward, the figures would remain the same. But this is just the comparative purposes. But anyways, in essence, it would remain the same. But more importantly, the reason of showing even 17, 18 and 19, 20 is the fact that you could potentially file amended tax returns if you were to have the partnership in place, and then you would do the incorporation, and you could amend your tax returns and get the tax refund back. Because so there's something called special relief, which will allow you to go back up to 9 years.
Okay, that's
and amending your tax returns. Otherwise, usually you get only 12 months from the end of the year. So for example, if the year end is 2021 and the deadline is 31st of January 22, you have only up until 31st of January 23 to amend your tax return. That's the normal norm. That's the usual one. But you can go up to 9 to 10 years with the special relief. Usually you can go up to 5 years, which is called overpayment relief. But there's always it's always worth reviewing what you have actually paid. If you actually have paid more, why not amend it and get it back? And HMRC would give you back. It's just that sometimes it's scaremongering by the other tax advisors would say, no, don't change it, don't do it, don't review it. But as long as you know what you're doing and you're confident about what you're doing, then that should be sufficient enough, because even if the inquiry were to come in, you're all here. You can provide all the documentations and the information based on which you amended your tax returns.
So I think you nearly said there's always a loophole, but I won't put words in your mouth, right?
No, I won't say loophole. It's just the legislation which we are not aware of. Not many of us are aware of. There's something called overpayment relief, which gives us the right to go back up to 5 years. In the special relief, I would say 9 to 10 years, but actually there is no limited number of years. As long as you know, as far as you are confident that if the inquiry were to come in, and if HMRC was to say, okay, on what basis you've changed these figures, you have your calculations, you've got nothing to hide, why would you worry for?
Yeah.
Okay, now you said that there's relief going back on overpayment, but the incorporation has taken place, so to say, now.
Sure.
You cannot go back and claim something which you were not incorporated then.
No, absolutely not. But at the same time, what I have just given you is the brief of the
Mhm.
actual work that goes in the background. So incorporation would go with effect from, of course, it cannot be retrospective. But in the background, what needs to happen is to existence of partnership.
Mhm.
Now, with the partnership comes various other tax savings routes that would inevitably ask you to amend your self-assessment tax return to begin with.
Mhm.
Because surely I would have filed my self-assessment tax returns under a typical UK property income section saying property income, which I would change it and say that no, it's not property income, it's my partnership share of profits.
So what,
And
what
when
you
I
mean
prepare-
is you were in a partnership, but you didn't realize it until someone spoke to you and then you put them right.
Absolutely, yes, yeah, because incorporation, like I said, would trigger two taxes at least. It
Yeah.
would trigger capital gains tax. It would also trigger the stamp duty, land tax. So there are routes by which you would make sure that you have tackled and you have avoided both of them. Because even if you are hit by one of them, it could be lethal. When HMRC were to come back to you saying, pay the stamp duty, land tax on 1 million. You don't want to do that. So yeah, but when you change the entity, there's a huge potential for that comes as a result of tax savings, which we come across all day long when we go through the property incorporation for our clientele.
So Surinder, basically what Arif is saying, go and see him.
Why not? If I'm going to save some money.
Yeah, that's what you're saying, right? Inverted commas. Come and see me and we'll see
All
if
I'm
you're in a
saying
partnership.
all I'm saying is do anything and everything that is needed to mitigate your tax affairs.
And as long as it's
all I can
legal, of
see-
course.
Of course, it has
Right.
to be.
Arif, I'm just going to pick up something slightly interesting. So usually when everybody talks about incorporation, they go straight into it, but you addressed something really interesting. You talked about 5 properties or more, and then you gave a solution for below 5 properties. Just to clarify, so if your income plus your rental is below, I think it's 50,261, I could have that figure wrong.
Yeah, somewhere in the range of 50K. You don't need to do the incorporation. That's the
You
reason
don't
I'm
need to worry
asking
about none of this stuff. right?
Ranjit, what your income tax level is. I mean, if your income tax level, if you are basically a taxpayer, even after the section 24, it would not hit you because you get the basic relief anyway. So it doesn't
Right.
hit you. Unfortunately, it has been sold. The incorporation has been sold as the off the shelf as opposed to the bespoke, and tax planning should always be bespoke to the client's circumstances.
Yeah, so there's an interesting cutoff. Now, where the guys are over, where you're over 50, whatever, 1,000, did I understand that right? Because of the interest rates are going up, not only are your expenses are going to go up and you're over this 50-something thousand rental and income limit, but the extra money you're going to have to put in is going to be higher because the interest rates are a lot higher. Is that right?
Yeah, so it's just like, for example, if my income is £100, I'm spending £60 to get that £100, but I can't deduct that £60. Now that 60 has gone to 75. I can't deduct still that 75. So I'm paying tax on £100, which is 20% or 40%. And on top of it, I have to also pay 75% from somewhere.
Yeah.
So that's what in essence is happening, because I should have ideally deducted my £75 from my £100, which I cannot now.
Yeah. So it's going to be.
So it's even more hard hitting with the increase in interest rate, basically.
Yeah.
If you are a high rate taxpayer, it's going to hit you even more harder.
So you did an illustration where in a limited company, you could take a potential dividend out. But am I right in understanding if you've transferred your properties to a limited company, you've effectively given equity as a director's loan to the limited company?
In essence, yes, yeah.
Yeah. And that limited company, when it makes money on the rental, could, rather than giving you a dividend, it could just simply repay your director's loan back, and there's no tax on that.
Absolutely. That's what the major advantage here as well.
Yeah.
So you're saving that as, you're saving the dividend tax, which is as of now, if it's high rate taxpayer, is almost 1/3.
Yeah, I think I should redo your slides for you, mate, and you should check.
Well, let's not go down there. The thing I want to clarify is so that you could end up in a situation where you said you had say £100 rental income and £75 expenses and 40% tax. You end up making a loss. over the year.
Absolutely. You would make a loss because you've paid 40% on £100, which is £40 gone. And then you have to pay £75.
Which you haven't got.
Yeah. And no wonder you would see more properties out in the market for sale. But I would say the demand would still remain as there are more people to want to buy. But in terms of the buy-to-let landlords, they would be a bit more skeptical to buy more properties now, unless you are a developer and you intend to add some value to the property. But yeah, it's going to be a mix. But I wouldn't have thought the property prices would go down dramatically, rocket low. I don't think that would happen because we live in an island. And my personal presumption is the fact that it would go back to what it was in 2 years' time. Because we would always need properties in this country. You would not and should not go wrong as long as property you have in this country, because we live in an island and government knows that very, very well.
Even with a 6% mortgage rate?
Absolutely, yeah. Because what do you think? Would the landlord be able to absorb the entire interest cost increase? No.
No, they're going to say
that
something.
would result into the increase in the rentals. Inevitably, that would happen. Somebody somewhere is going to pay. I wouldn't say completely the tenants would pay, but some portion would be paid by the tenants.
Okay,
if not all.
A couple of points there. What you're saying is, in actual fact, you're saying is the property value graph will be going up, but there'll be a blip for a couple of years. It'll go down and up again.
Property value graph will always go up. I can't
in the long term, right?
In the long term, would always go up. Yes, yeah, you would have hiccup here. So I could see perhaps the drop, a minor drop, or stagnant. And stagnant could also be considered as a drop. I mean, you got a London property worth 1 million, and for 2 years, or 2.5 years, it means 1 million. Now, that is not something you expected, isn't it?
Yeah.
You bought it for an automatic increment. That's what we're all here for. So that itself, if it's stagnant in itself, is a hit. It's a big hit.
Sure.
So yeah.
I think we're gonna. So it depends where you think of your property prices. So I'm still in 2020 land, right? And I think there's been a 20% increase since then. All of that's going to get reversed. Perhaps a little bit.
Go
more.
again, Dil. I didn't get you. I didn't get you.
So I don't know if you remember 2020. It was a fantastic time. No one could go out. It was really good fun, right? And now everyone's
I had some glimpse of it.
Yeah, right. Okay. So, everybody's forgotten all of those fun times. But, because the government was throwing money at everybody and the interest rates were about to go negative, everybody managed to overpay property prices. So I think all of that's going to get reversed. Stamp duty was, they did something with it. Another silly idea.
Yeah, they did something with it. I mean, it's not a huge one. What they did back in that budget, when Rishi was there, effectively you could get up to £15,000 worth of stamp duty refund. Well, stamp duty reduction. Now it's just £2,500.
Yeah.
Now it's more biased towards first-time buyers. You get more if you were to be a first-time buyer. But how many of first-time buyers you would have thought would have the guts to buy in these dire conditions? Of course, there would be. But I wouldn't have thought the numbers would be as high as what the numbers were back in 2018 or even 20 for that matter. But yeah, because everybody is skeptical with the scaremongering that is happening in the media. Everybody is skeptical, especially the utility cost, the rising interest rates, everything is there. So yeah.
I agree. I think more people are going to continue renting, aren't they?
You would have. I mean, you would have. Even if I were to be a first-time buyer, and again, it depends. If I want to be a property developer or landlord, then my approach would be different. But not every first-time buyer is a developer or a landlord, would he? Or anticipate or perhaps see themselves to be one of them. So I'm guessing 75 to 80% of them would be just the first-time buyer who want to live in the property and who want to have that particular property for a long term. And that case, I won't buy it now.
Well, in London, we've got a different problem. Most first-time buyers are a Help to Buy people.
There you go.
And those are the guys that are going to get trapped in their nice, shiny new flats that become old as they go along.
Yeah, that's even worse, because then you're paying interest on some part that you own, which is shared
Yeah.
ownership, and then you're paying rental on the other part which you do not own. It's even more complex to a large extent. And the rental will go up, the interest would go up, and eventually you would end up owning just part of your property, not the whole of it.
You mentioned rents,
muddle up.
rents inevitably going up. But there is a development today in Scotland freezing rents, which will be
Yeah,
low.
but we
by
don't
the
live in
season.
Scotland, do we?
No, but we have
Srinder does. Hang on.
some of us have properties in Scotland.
Have
Yeah,
you?
surely. I mean, depending on the area we're talking. So we are talking about majority England, where the
Mhm.
market is always high compared to Scotland and Northern Ireland and Wales, even for that matter. Yeah, I mean, market here is always high. The demand is always high. When we go and we talk about Scotland, yeah, things are different. I mean, I have not given the figures from the Scotland point of view. Scottish rates are different. The
Sure.
mini budget for Scotland is different.
And hang on a minute, Arif. This is a really
I didn't
interesting.
realize, Dil, you had a Scottish partner, but if that is the case, then
No.
I should come up with a new,
I want to know where Srinder's castle is in Scotland.
Well, that's for
No,
me
he
to-
likes fishing.
That's for me to know and you to find out.
Mate, listen, you've never invited us to your castle. I think, you know, when Her Majesty passed away, did she give you a little present?
It's a secret. You can't reveal that.
Oh, come on, look, you can't leave us sort of dangling the carrot like that. It's
Okay,
like,
changing the topic, Arif.
Oh.
You talked about something about dissolving the trust if you were in dire circumstances. In that case,
you can, yeah.
so say I had a trust and I'm in trouble today and I want to dissolve it. What would be the consequences of that be to the
It's
beneficiaries?
nothing because
Would the
when you say
beneficiaries have
trust,
to return the money to the trust?
none, because you actually own the property. You actually own everything. Nobody owned anything.
No, but you have given the beneficial interest to others.
You have just given the beneficial ownership to the
Yeah,
others,
so-
not the
so-
legal ownership.
So
The
are
legal
you
ownership always remains the same.
So,
So
sure.
it's my pen. It's still in my hand. I'm
So
just not using it.
No, but I want the beneficial interest back. All right. So what about the beneficial interest the others have had? So is that past, gone, written off?
So whatever you have, for example, rental income, and if you have given the dividend from the rental income to beneficiaries, that has gone. But
Right.
your capital is what we are concerned about. That
Right.
would always be in your hand.
Okay.
And
So-
that would, nobody
So
can take the right to it.
There'll be no consequences for the beneficiaries to pay anything back to the trust.
No, because you have given it. You have given the dividend to beneficiaries. You can't
Mhm.
you can't ask to take it back.
But
But what you can control is your capital.
But on the other hand, it just says that if I receive something from a trust, it never belongs to me. It cannot be in my as my what you call it for me to pay tax or to do anything else upon my death or whatever. If that money has to go back to the trust.
you're talking about a loan rather than an income, right?
I didn't get you, Surinder.
Well, in the trust, I've heard people say that once you have a trust, and
When
the trust,
people say, I've heard people say, that's
okay,
a very
I've
dangerous line.
had,
It's like I've heard people say Dil has got 3 castles in Scotland.
yes.
No,
well,
the Srinder's got the castle, not me, right?
It's all right. It is once the money you put in a trust and give it to the trustees is protected. I'll give you an example of that. Say I had a trust and I had given it to my son, daughter, whoever, who used to buy a property or whatever, and then their marriage was in difficulty. That money which came from the trust is not counted as their asset. It has to be returned to the trust.
There is no question of returning. It doesn't belong to anybody. It is belonging to trust only. And if you are the trustee, then it belongs to you. You are the owner.
I think what Srinder's
So
saying.
it has never passed to your beneficiaries. Even though you've put £100,000 into the trust and with the £100,000 you bought a property, the property belongs to trust, never to your beneficiary.
No, okay. If the trust is then borrows against it and gives it to the trustees, what happens then?
To the beneficiary, sorry. You mean the beneficiary?
To the beneficiary.
Are you talking about the capital distribution or the income distribution?
Well, it becomes, well, it will be the capital distribution, obviously.
So when you do the capital distribution, that particular asset goes out of the trust then. There's no longer part of the trust. As long as it's part of the trust, it is completely owned by the trust. So if you buy the property for £100,000, it's owned by the trust.
Okay.
If you
property is owned by the
remortgage
trust,
it,
but
even
it
if you have
but
more
it has a
money-
mortgage on it, then you've
It has-
created a mortgage and given the money raised by the mortgage to your beneficiary.
You're making things more complicated. It doesn't work that way because mortgage, if you were to mortgage the property, you cannot gift a debt, can you? You can only gift, like I said, trust is a form of gift. You can only gift what you own. I cannot gift to you, I got to pay the £100,000. That's my gift to you. Pay him. I can only gift you what I own. Say this is worth £250,000. I'm gifting it to you. That means I'm only gifting it to £150,000 out of it. The £100,000 that I have to give it to Dil, that's between me and Dil. That you're not party to it.
Let me clarify what I think Surinder's trying to say. You put a property in a trust, the trust takes a mortgage on that property, but rather than give the beneficiaries money, it gives the beneficiaries a loan. And if the beneficiaries then, if they're your children that would then split up, the trust can then say, give me my loan back, and the money comes back to the trust. Is that the right illustration?
That's a separate transaction that's a loan transaction between the trustee and the beneficiary.
Is that what you were trying to
do? That is not a transaction between you and the trust that you initially gifted. We are talking about your initial gift that you had given. You can take it back.
Surinder, did I get that right?
Yeah, you got it right. So if I dissolve that, so I only get back, I can't get back that unless that loan is recalled from the beneficiary.
Because that was your second decision. Loan is a second transaction. When we created the trust, what you had actually done is transferring your asset into trust. Then you went one step further. You actually gave some of your assets as a loan to your beneficiary or anybody for that matter. Now, first of all, your trust deed should allow you to do so. And whether you're doing it for free or whether it should be for the interest, whatever the terms are. And then that's a separate transaction between the trustee and the beneficiary who took the loan. That's a separate legal arrangement compared to what you had actually given.
No, that's sure. But if that exists, how can you dissolve the trust?
Yeah, then surely, then you need to make sure that you get the trust funds back. Your loan needs to be repaid back. You should have thought about it. Now there could be endless possibility of these kind of complex transactions happening. What I'm thinking is a pure you or anybody for that matter, putting into trust and then having that particular property within the trust and use it for long term so that you can save the inheritance tax after you live 7 years from the date of you transferring it. Now, after that, what you do, say, for example, if the property were to be mortgaged, now you can't dissolve the trust up until the time you have paid off the mortgage. Forget about your loan. Loan doesn't matter. That's still between you and your beneficiary, your son, maybe. But loan is a third party lending. You have to pay the banks. Bank would not let you dissolve it. You're talking about a mortgage-free simple income. So obviously, if you have created more complexity within your trust, which is not there at the outset, then you are the person responsible to resolve it before you can dissolve it.
Sure. Okay, I understand. That's fine.
Surinder, you're not going to get a mortgage on your trust stuff. You're just going to have to sell one of your castles in Scotland, buddy. I'm sorry.
Okay, are you ready to buy?
Well, price is right. Yeah, if we're on for a castle, right?
Why not? Why not?
There you are. I've got a JV partner. I'm going to ask Charanjit, do you want to buy a castle in Scotland?
I'd love to buy a castle in Scotland.
Right. Okay. We're going to have to buy a castle in Scotland now. That's the next TPB project. When King Charles gets rid of one of his extra ones, let's put in a bid for it.
You're going for Balmoral then?
No, Balmoral's got too many sad memories. I can't buy that. That's Her Majesty's former home, right? We need something more interesting.
Okay, before we get sidetracked, I think, Arif, you've done a very good job. Thank you very much indeed, as ever.
Thank you all again, as usual.
Yeah, as usual, you've done a good job. So,
as usual, and Surinder, thank you for putting the 50p's in because we didn't run out today.
Good. I'm glad you approve.
That's
all I'm here for, your approval.
And listen, Arif, You've heard it on TPP. Surinder is going to invite us to his party for his castle in Scotland, right?
Absolutely.
Right. Arif, thank you very much. And
Thank you all.
Just put your slide back on for a second, if you don't mind.
Which one you're referring to?
You know, the last one with the 50p slot and the thing.
That's the one.
Yeah, that's it. How come your name's not there with all the letters of the alphabet behind it? Because it's like, how many of you got 35 or 36 more letters than the Russian alphabet?
I have lost the count now.
That's why you don't put it on there anymore. It's like
Yeah, it's not
you've
working.
run out of letters. There's no
Yes.
space.
Yeah, more or less.
Okay.
Right.
Okay, thank you.
Thank you very much.
Thank
Thanks a
you,
lot. Thank
Chiranjeev.
you.
Thank you.
Thank you.
Bill.
Everyone,
And-
thank you.
Thank you.
Next week, we're back again. Next week, we have Linda Wright.
No, it's secret. Come on. You got to fill the suspense. What are you doing?
It's an open secret. Linda Wright, she'll be talking about planning and supposedly proposed planning changes coming up.
Oh, another change that might get undone from the government. Wow, can't wait to hear this one. There's even Srinder's laughing at that one. Thank you very much.
Thank
for
you.
watching.
All
Thank
right.
you. Thank
Thanks,
you all.
everybody. Thank you
Thanks
very
a lot.
much.
Bye.
All right. Bye. Okay, Dil. Let's just